Well, good morning. Today our topic of discussion is pricing decisions, profitability and cost management. So that's a whole topic. I divide this whole topic into two parts, part one and part two. So now start with the part one. Uh, and I'm going to use the pencil so that, okay. Okay, so as the name is reflecting, so these are the learning outcomes for this chapter. Major influences on pricing decisions. So, what are the main components that or the forces that force the management to decide a particular price? And then we try to understand how the firms make their pricing decisions in the short run and in the long run. So this is the way that we're going to discuss, because in the short run, the scenarios are different and the market forces are working differently. And in the long run, as the cost is also going to change and as well as the demand of the product is going to change. So for that reason, there is a different strategy or a different reasons for making long-term prices. So price products using the target. So now there are three approaches to make pricing decisions. One is target costing, like we know that how much our customer is willing to pay, and for that reason, we set a target that we want to produce the product within that cost, and this is our profit margin. And by this way, this is the price. So it means that they already targeting a particular cost to set a particular price. The other way is cost plus approach, which is commonly done by the manufacturers. Like, what is the cost of their manufacturing? Plus, they add up their profit margin, and by this way, they can determine the price. But in a competitive market, it's hard in a way that if our cost structure is or cost is higher, and by this way, if we add up on our profit margin and the prices are higher than our competitors, so we cannot survive in this way. So this is one of the approach in which if the market is monopoly or a monopolistic competition, in that case, it's going to work, but not in a competitive market. And the third approach is that we want to calculate the cost of a product over the life cycle. And this is what we call it as a life cycle budgeting and costing. And there are many names for that, like from cradle to grave, or from childhood to the death. So there are many names like that. So we, in this particular approach for setting price, is that when we spend money for research and development and designing phase, and then when we spend money for reclamation of the uh, sites where we create environmental effects, or when we want to vary the effects of those things what we use for doing that particular production of goods, uh, we have to take care of those costs as well. So the cost of very initial investment for development of the product, from designing to the research and development, and towards the end when we are spending money to recycle or refurbish or the places we damaged because of the production of that product. So normally the firms are not treating those expenses towards the product, but this approach is saying, no, we have to add up into that as well. So as I mentioned that there are three strategies like what we discuss here, three strategies for making price: target costing, cost plus, and life cycle budgeting and costing. So three prices that are discussed in this chapter is target pricing. Price is based on what customers are willing to pay. That's a target that we want. We want to set up a particular price, and based on that price, we have to restructure our product in a way that the cost is gonna should be within that price, as well as our profit margin is there. Cost plus pricing, a flat rate target profit percentage is as it to the full cost of the product. And the third one, as I mentioned, life cycle pricing or a cradle to grave, includes environmental cost of production, reclamation, recycling, and reuse of material. So these are all the costs when we want to calculate the cost of the product. Now, these are the three very specific strategies we're going to discuss in detail in this chapter. So these are the learning objectives of this chapter, and these are the three main strategies we're going to discuss in detail. But before starting these target pricing, cost plus pricing, and life cycle pricing, we have to see that what are the main influencers that influence our policy decision or a policy price on policy or regarding price. So price policy. The company's price a product or a service ultimately depends on demand and supply for it. Definitely, the market conditions determine the price and quantity by calculating the market price based on demand and supply. Now, how the demand is going to affect and how the supply is going to affect, these are the we call them as an influences. The main influence is the demand side. And who is the main contributor in the demand is the customer, like the how much the customer is willing to pay. That's a demand curve. Or if we want to talk what is demand, it is the customer's willingness to pay. So the customers are the first one, the priority in influencing our price policy. So influence price demand for product or service based on quality. Definitely, the customers are influenced or impressed or become loyal to the product because of the quality, availability, and sustainability. So these are the reasons that can affect the customer, and customer is the main player in determining our one of the main player in determining our price policy. The second is the competitors, like those who are selling very similar products than ours. So effect on price, again, the market structure depends that if it is a competitive market, then competitors are not so much important. But if it is a monopolistic competition, like an imperfect competition or a oligopoly type of market, yes, competitors matter. And if it is a monopoly, then there is no competitor. So that is not the important factor there. So customers and then the competitors, effect on pricing differs due to the competitive environment, monopoly versus competition, or price schemes, product features, and production volume. So these are the things that affect our competitors, or we take influence from our competitors. A company must accept the price that customers are willing to pay. If we charge more price to our customers, so there is a possibility if the substitutes are available for our product, so customers can go to that product as well. The third factor, which is also the most important factor that influence our pricing decision, is the cost. Definitely, no businesses can afford to sell a product less than the cost. The reason is that we cannot sustain a loss forever. So we can do this for a short period of time, but not for the whole period, because the objective of doing business is to make profit. So if the price is less than the cost, then it doesn't make sense for any business model. So cost influence price because they affect supply. Now, if we see in context of supply and demand, so we know that the demand is all based on the willingness to pay by the consumer or a customer, and the supply curve is all influenced by the supply. And sometimes we also call the supply curve as a marginal cost curve. So the supply curve is going to expand or shift to the right if the cost go down. And the cost can be go down because of the decrease in input prices. It can be decrease in we can say wages, or we can say raw material and all these things. So that has a influence on the supply side. So price must cover all cost in the long run and produce a profit. So that's what I said, that price must be covering the cost. Otherwise, there is no business can survive for a long period of time. So as we discussed in the beginning, the learning objective, so we divide the whole pricing policy into two time horizons. One is short run. Pricing decisions have a short horizon of time, less than 1 year, and include decisions such as one-time only special orders. Like in some scenarios, the firms get one-time special orders, and that's a you have to make a decision whether you have to accept that order or not, based on a short run analysis, because that's not for a permanent change. Adjust product mix and output volume in a competitive market. So we can change our product mix with, if our firms are producing 4 or 5 different types of product, they can change the quantities or a volume in a competitive market so that they can adjust their pricing policy. But in the long run, pricing decisions have a time horizon of 1 year or a longer, and include decisions such as pricing a product in a major market where there is some leeway in price setting. Like if the price setting is only possible in a monopolistic competitive market or an imperfect competitive market, because the competitive market, the price is determined by the market, not by the producer or the seller. So that's a big difference, that price setting is only possible when you have a leeway in setting the price. Means that you are selling some product which are differentiated, which are a little bit different than others, or which can be a better than others. In that case, you are able to sell at a higher price as compared to the market price. For example, we see like a coffee, Tim Horton coffee and a Starbucks coffee. So both are coffee and comes under the category of beverage, hot beverage. But we see that the one firm is charging more price as compared to other. The reason is that the firm has a levy on setting their price higher because of the because they can claim it that it is because their quality is better or their service is better, or whatever they can claim it, and people are ready to pay, and that's the reason they are charging for that. So uh, our next point is our difference affecting pricing long run versus short run. So differences affecting pricing long run and short run. Costs that are often irrelevant for short run policy decisions are fixed cost, because in a short run you cannot change the fixed cost, like a plant size, like a land for a farmer. So these are the things that we cannot change, and fixed costs that cannot be changed are generally relevant in the long run but not in the short run. And profit margins in the long run, pricing decisions are often set to earn a reasonable return on investment. In the long run, we try to set the price with this perspective that every business person or everyone who is investing in particular business have a certain amount of return on their capital. They have some figures in their mind, like I want to earn 12%, 10%, 15% returns on my investment. So by keeping that view, in the long run, the price is set in a way that this objective of returning a specific rate of return on their investment and should be achieved. So prices are decreased when demand is weak. Definitely in the long run, if the demands go down, we have to adjust the price, and increase when the demand is strong. So uh, prices are flexible more in the long run based on the market conditions. Uh, Now, how we make a special order decision, like if we receive a special order, one-time order, then how we can make that decision. So whether we accept or reject, because that is not going to affect our overall normal sale, not affect sales from existing outlets. So customer is unlikely to place future orders, and idle capacities exist, means that we have a capacity that we can fulfill that order. In that case, what we can do, or how we can charge that, uh, whether we accept or reject. So gather information. The first thing is, yeah, we have to gather information. Focus on future direct and indirect costs that will change by accepting one time only or special order. So we have to keep in mind when we are making this decision of one-time order to accept or reject, what is the implication of this acceptance in the long run or in the future? Uh, or is there anything we need to change in our process of manufacturing or producing that is going to affect our future cost? So forecast future outcomes based on available information, decide among alternatives that consider qualitative factors as well as quantitative analysis. So we have to do analysis like this special order is not going to affect our uh, special is not going to affect the quality of our other products or the normal output. And also we have to see that quantitatively, is it possible that we can produce it? So these are all the things that we have to talk and discuss before making a final decision of accepting or rejecting. Evaluate performance, gather performance data comparing actual profitability to predictable profitability. And later on, then you have to analyze whether the decision was good or not by calculating the profit and see that what we anticipated with this order acceptance and what you actually got. And by this way, in the future, it's going to be helpful in making such decisions again. So here is a case like I'm going to read it this case little bit from the book because there is only the figures, but it's important that we have to understand the case. So there is a computer firm, Astel, can bid on a data tech offers. Astel's managers must estimate how much it will cost to supply 5,000 units of computers. So the order is of a 5,000 units. Astel's manager must include all direct and indirect costs throughout the value chain that will change in total by accepting one-time special order from DataTech. Astel's managers outline the relevant cost as follows. So this is the relevant cost as follows. Like this is a special order Astel computers are getting from DataTech. And what is the order that they ask for them to bid for a 5,000 computers they're going to supply. So before going into the bidding, they have to calculate the cost because by this way they are able to bid correctly. So direct material for this 5,000 unit is going to be cost us $460 per unit, and we see that it is $2.3 million is a direct material cost. Direct labor cost is $64 per unit, and 5,000 units we are selling, so 320,000 is a direct material cost. Then fixed cost, equipment startup, that is 250,000. So total direct cost is 2.870 million. Now, direct cost, if we want to find out the direct cost per unit, we divide this whole cost with a 5,000, so we get it like 574 is a direct cost for producing these 5,000 units. Per unit cost is 574. Astel bid per unit for 610. So if they bid for 610, how much revenue they can generate? We know that 500 multiplied by 600 and 5,000 multiplied by 610. So we see that the total revenue we are generating is 2.870. Sorry, this is 610 into 5,000 minus 2.870. So the potential increase in net income is 180,000. Based on the market intelligence, Astel believe that the computer bidding will be between 600 and $625. So that's a market information that the other bidders going to bid between 600 to 625 per computer. So Astel make a bid of 610 per computer. If it wins the bid, operating income will increase by 180. So we just calculated here that how we can get it 180. It is because of the difference of the cost, direct cost, and the revenue what we can generate, or we can say it is a uh, pro forma analysis of the cost and the revenue. So, but it is again, we are keeping just only a direct cost per unit, but we know that there is an FOH or a manufacturing overhead, MOH or FOH, factory overhead or manufacturing overhead. This figure is going to be 3,050,000, and we know this is the cost, direct cost, and by this way we get it 180. In the light of the extra capacity and strong competition, management strategy is to bid as high above 574 as possible while remaining lower than competitors bidding. So they know that the price should be in between because they want to win this contract, and for that they have to bid in a way that they should be least price bidder, so that the bid is going to accept it. So they have to compete it with the competitors in a way that they can bid any price between any price above 574, because 574 is going to be their direct cost. So what if Astrals were the only supplier and DataTech could undercut Astral's selling price in an Astral's current market? The relevant cost of bidding decisions would then include the contribution margin lost on sales to existing customers. What if there were many parties eager to bid and win the data tag contract? In this case, the contribution margin lost on sales to existing customers would be irrelevant to decision because the existing business would be undercut by data tag regardless of whether Astral wins the contract or not. In contrast to the Astral case, in some short-run situations, a company may experience strong demand for its product or have limited capacity. In these circumstances, a company will strategically increase prices in the short run as to match as the market will bear. The result is high short-run prices in the case of a new product or a new model of an older product, such as microprocessors, computer chips, cell phones, and software. So every new model is going to be charged at a higher price because there is a demand. And you know that in many cases, like Apple launch a new iPhone or new iPad or a new Mac, they introduce with a high price as compared to them because they know that their market is strong and people are ready to buy their new product. So, as we discussed, the alternative long-run pricing approach is a market-based. Price charge is based on what customers want and how competitors react. Cost-based price charge is based on what it costs to produce, coupled with the ability to recoup the cost and still achieve a required rate of return. So these are the two approaches in the long run. In the short run, we discussed that the market is more important, but in the long run, we have to keep it in mind, the market as well as the cost based approach. Now, here is an example of a ABC manufacturing cost of a pro value for uh, 2018 using activity-based costing. So we see here that the manufacturing cost of 150,000 units, direct material, direct manufacturing labor, direct machine, and then we have a manufacturing overhead cost as well, like ordering and receiving, testing and inspection, rework, and manufacturing overhead cost. And overall, we see that the cost, the direct cost is $600 per unit, and the indirect cost or manufacturing overhead cost is $80. And so altogether, the total manufacturing cost is 680 per unit. And overall, the total cost of manufacturing is $102 million. Now we have to see that how much revenue they can generate and how much cost of goods sold we have to charge and see whether the company is earning a profit or not. So, for example, they are able to sell this 150,000 units at a price of $1,000 per unit. And by this way, we see that they are generating 150 million. This 150 million is the cost of goods sold is 102 million, which we calculated here, 102 million. And we then we also add up the other costs. Other cost means the research and development cost, design cost of product and processes, marketing cost, distribution cost, computer services cost, operating cost, full cost of the product. This is the full cost of the product when we add up all these costs to the cost of goods sold, which is 135. So by this way, we have a $15 million net income or operating income. And when we divide this with the 150,000 units, so we get 100 unit per dollar is our operating income. So markets and pricing, competitive markets use the market-based approach. As I mentioned in the beginning, the market structures are very important when we are deciding the price. If it is a competitive market, the manufacturer or the producer has a very little power to set the price. It is all by the market that is going to determine the price, and that's why we are saying here, use the market-based approach. Market-based approach. Then, if the market is a less competitive, like an oligopoly or a monopolistic competition, can either use the market-based or a cost-based approach. So in that case, we can apply both or a combination of both, like a market-based as well as cost-based approach, because we I gave you an example of a Tim Horton and a Starbucks. So they can charge a higher price than their competitors because of the quality and services. If they can convince the customer that my quality and my product is better as compared to my competitors who are selling you at a lower price, but their quality is cheap. The third one is a non-competitive market, use cost-based approach. Non-competitive market means if there is a monopoly, so the best thing for the monopolist is to charge the price based on their cost approach. Like if they calculate their cost and then they add up their profit margin on top of it, and then they can set the pricing. So it means that for a monopolist or for a non-competitive markets, the price setting is easier because they use a cost-based approach. They calculate exactly the cost of that, and then they add up their profit margins in order to determine that how much price they are charging. But if it is a competitive market, then the firms are their hands are tied and they cannot do anything particular in their prices. What they can do is just to get or increase their profit is that they reduce the cost, they make it more efficiently so that their costs go down and they can make a more profit. Less competitive markets in between, the hybrid type of market that has some features of monopoly, some features of competition, and by this way, they have a little power to or little market power by which they can set the price, and they are definitely is going to use a hybrid way of deciding the price. So start with the target pricing. Now this is that how we can set the target pricing. In a market-based pricing, we start with we discuss three different strategies of setting price. Number one, target. Number two, cost plus, and the third one is a life cycle approach for calculating life cycle budgeting approach for calculating the price. So here's an example. Start with the target pricing. Estimate price for a product or a service that potential customers will willing to pay for competing products or services based on customers' perceived value for the product or service and how competitors will price competing products or services. So this is the market-based approach that we have to figure it out, the demand, that is willingness of the customer to pay, and as well as we see that how the competitors are paying, charging them. So by this way, we can set a target price. So target cost, estimated long-term cost per unit that when sold at the target price enable the company to achieve its target margin percentage. Understand customers and competitors is important because competition from lower cost producers has meant that prices cannot be increased. Products are on the market for a shorter period of time, leave less time and opportunity to recover from price market mistakes. Customers have become more knowledgeable and demand quality products at a reasonable price. So what we have to understand the customer and the lifespan of the products are not so long that we can first make a mistake of calculating the price and then when we can readjust. The markets are very smart. The customers are smart. They know the things very clearly in this age. Now, many companies, many corporations failed. Be- The only reason behind that failure is that they are not able to price their products correctly. And if you read the literature of these corporate world in the corporate world, and we see there are many other reasons as well, but the main reason for a failure of many firms are because they are not setting the price correctly. If they are not able to set the price correctly, that can be a detrimental for the corporation. There is a possibility that they can become uh, out of the business. So this is the important feature for deciding whether what price we're gonna charge. So this is the first part, which is mostly theoretical, and we are just talking about more economics as compared to the managerial accounting.